What is inflation? The silent thief stealing your money. Have you ever looked at a restaurant menu, a grocery receipt, or the price tag on something you wanted to buy and thought, I'm sure this used to be much cheaper? If so, you're not imagining things. Prices really have changed. Take a simple loaf of bread as an example. In 2020, the average price of a loaf of bread in the United States was around $1.50. By 2025 and into 2026, many similar loaves were selling for around $2 to $2.50, depending on the brand and location. The bread didn't suddenly become twice as large or twice as delicious. So why are you paying so much more? The answer is inflation, one of the most powerful economic forces in the world, quietly affecting every person who uses money. Unlike a thief who breaks into your house and steals your wallet, inflation works silently. It doesn't take away the number displayed in your bank account. Your balance may still show exactly the same amount of money tomorrow as it does today. What changes is something far less obvious. Every dollar you own slowly loses a little of its purchasing power. That means the same amount of money buys fewer groceries, less gasoline, fewer clothes, and fewer services than it did just a few years ago. This is why inflation is often called the silent thief of wealth. Imagine that it's January 2020. You have $100,000 in cash. Instead of investing it, depositing it into interest-bearing assets, or buying anything with it, you decide to lock it inside a safe. You tell yourself you'll keep it there for 6 years because cash feels safe. Time passes. It's now 2026. You open the safe, expecting your wealth to be exactly the same because nobody touched your money. Inside, every single dollar is still there. You count it carefully. $100,000. Not a dollar is missing. At first glance, it feels like nothing has changed. But then you start spending it. You visit the grocery store and notice that many everyday products cost more than they did in 2020. You look at restaurant prices, airline tickets, rent, insurance, healthcare, and even a simple cup of coffee. Almost everything has become more expensive. The amount of money you own hasn't changed, but what that money can actually buy has changed dramatically. In other words, your wealth has quietly shrunk, even though the number printed on your banknotes stayed exactly the same. This idea is called purchasing power. Purchasing power simply means how many goods and services your money can buy. When inflation rises, purchasing power falls. That's why economists don't just look at how much money people earn. They also look at what that money is actually worth after inflation. Receiving a higher salary may sound like good news, but if prices are rising even faster than your income, your standard of living may actually decline. So why does inflation happen in the first place? To understand this, imagine a tiny island with only 100 people living on it. Every day, the island's bakery produces exactly 100 loaves of bread. At the same time, the entire island has exactly $100 in circulation. The economy is perfectly balanced. Each loaf of bread costs $1 because there is exactly enough money to buy exactly the amount of bread available. Now imagine that overnight, someone magically prints another $100 and gives one extra dollar to each person on the island. Suddenly, everyone feels richer because they have more money in their pockets. Naturally, more people decide to buy bread. The problem is that the bakery is still producing only 100 loaves. There isn't any extra bread. Demand increases while supply stays exactly the same. The baker notices customers are willing to pay more to make sure they get a loaf before it sells out, so the baker raises the price. Soon, each loaf costs $2 instead of $1. Notice something important. The bread didn't change. The bakery didn't suddenly become more valuable. The only thing that changed was the amount of money chasing the same number of goods. Of course, the real economy is much more complicated than a small island. Money supply is only one possible cause of inflation. Prices can rise for many different reasons. If crude oil becomes more expensive, transportation costs increase. When transportation costs increase, businesses spend more to move products across the country. Those higher costs are eventually passed on to customers. If wheat prices rise because of poor harvests, bread becomes more expensive. If electricity prices increase, factories spend more to produce goods. If wages rise because companies need to attract workers, production costs also increase. Every additional cost somewhere in the supply chain eventually appears in the final price consumers pay. Unexpected global events can make inflation even worse. During the COVID-19 pandemic, factories closed, shipping containers became scarce, and ports around the world experienced severe delays. Many products became difficult to manufacture or transport. At the same time, consumer demand recovered faster than supply. The result was a sharp increase in prices across many industries. Later, geopolitical conflicts and disruptions in energy markets pushed fuel and food prices even higher in many countries. These events reminded the world that inflation isn't always caused by a single factor. It is often the result of several forces happening at the same time. Not all inflation is considered bad. In fact, many economists believe a small and stable level of inflation is healthy for a growing economy. That's why central banks such as the Federal Reserve generally aim for inflation of around 2% per year over the long run. A modest increase in prices encourages consumers to spend, businesses to invest, and companies to hire more workers instead of waiting forever because prices never change. Moderate inflation is often seen as a sign of a healthy, expanding economy. The real danger appears when inflation rises too quickly. A good example occurred in the United States during June 2022, when annual inflation reached 9.1%, the highest level in more than 40 years. Families across the country suddenly found themselves paying much more for gasoline, groceries, rent, and household essentials. Even people who received salary increases often discovered that their extra income couldn't keep up with rising prices. Their paychecks looked larger, but their purchasing power continued to decline. This is one reason wealthy people think differently about money. Instead of allowing large amounts of cash to sit idle for years, they often invest in productive assets. These might include businesses, stocks, real estate, index funds, or other investments that have the potential to increase in value over time. Their goal isn't simply to earn higher returns. They also want their wealth to grow faster than inflation so that their purchasing power is preserved. That doesn't mean every investment is safe or guaranteed to make money. Every investment carries risk. Markets can rise and fall. Property values can change. Businesses can succeed or fail. The important lesson isn't that everyone should immediately invest. The important lesson is understanding that holding cash for very long periods has its own hidden cost. Inflation quietly reduces its purchasing power year after year. Think about two friends in 2020. One keeps $100,000 in cash for 6 years. The other invests carefully in a diversified portfolio that grows faster than inflation over the same period. By 2026, the first person still has exactly $100,000, but that money buys less than before. The second person's investment may have experienced ups and downs, but if it outpaced inflation over the long term, their purchasing power has been better protected. This simple example helps explain why financial education is so important. The truth is that inflation isn't your enemy. It's a normal part of almost every modern economy. The real danger comes from ignoring it. If you understand how inflation works, you can make smarter decisions about saving, spending, and investing. But if you don't, inflation can quietly reduce the value of your hard-earned money year after year without you even realizing it. In the next video, we'll explore another fascinating question. If governments have the power to create new money, why can't they simply print enough to make everyone rich? The answer may completely change the way you think about money forever. If you enjoyed this video, please like, share, and subscribe to Money Decoded for more simple insights on money, investing, and the economy. Don't forget to turn on notifications so you never miss a new video. Thanks for watching.